In this week's Property Insider Chat, Dr. Andrew Wilson and I explain how our housing markets received another boost in confidence in sentiment with interest rates falling at a time when wages are going up and there's a shortage of good properties on the market. Buyer sentiment has returned, as we're going to explain in our chat this week. We're also going to talk about what the implications of the lower interest rates mean for our housing markets. And Dr. Wilson's question, should interest rates have even dropped? Anyway, if you want to keep up to date with what's happening in our housing markets, please subscribe to this YouTube channel and click the little bell icon so you can be updated each time a new show comes out. The property market just got another boost, and it's not just sentiment driving the change. Australia's housing markets appear to be entering a new phase of momentum with a powerful mix of lower interest rates, higher wages, rising buyer confidence at a time when there's still a shortage of good properties. And that's igniting activity once again, which was shown in our auction markets over the weekend. So in this week's Property Insider Chat, I want to ask Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of my housing market, his views on the latest interest rate cuts and how he feels the housing markets will react. Hi, Andrew.
Yes, good morning, Michael. And it has been an interesting week, the last week. We had that interest rate cut, of course, from the RBA. That was widely signalled. In fact, some of the forecasts out there, some of the surveys out there were showing, less than a 100% prediction for lower interest rates over May. And I thought it was almost a certainty, given the comments from the Reserve Bank and given what most so-called pundits were predicting. So yes, another cut. I'm not sure, as a macroeconomist, I agree with why we're cutting interest rates at the moment in a very, very strong economic environment. I know there's some issues in regard to the risk to the international scene through the US projected tariff policy, whatever that is. It sort of changes from hour to hour. But nonetheless, normally we see lower interest rates to when we need to put our foot on the gas a little bit to pump the economy up. And
well, in their statement, the Reserve Bank governor said that they, for a really short time, talked about not dropping interest rates. That was discounted. The Reserve Bank talked about having a double interest rate drop of half a interest rate point, but that didn't happen either. And they decided that it's still restrictive, the rate things are at the moment, so they've dropped it a little bit further.
Well, this is what I can't understand, Michael. How do they justify that the interest rate policy is restrictive, other than looking at the historical evidence? That's where reserve banks and economists get into trouble. They keep looking backwards for some sort of a master plan of how to manipulate the economy. And as we know, those things change over time. It's sort of the evolution of economic dogma. And previous Reserve Bank entities, particularly our previous Reserve Bank board, got into a bit of trouble because it to some degree mismanaged monetary policy. Certainly its predictions were all over the place for a while, and that's why we have a different Reserve Bank board and a different structure for Reserve Bank reporting. But as I said, at the end of the day, it's welcome news for the populace because, everybody wants lower interest rates, particularly if it's in a strong economy. I mean, does it get any better? You've got basically a full employment economy and interest rates are falling. And I'm just trying to see the evidence that higher interest rates were actually contributed to our lower inflation, because our lower inflation is quite clearly a product of two primary forces. One is the collapse in the price of oil since its peak during COVID. The national price of oil is now floating around $60 US a barrel. It was over $120 US a barrel at its peak. So that's obviously had a big impact on inflation. And the other factor, of course, is the price of electricity. And that's also collapsed. But that's been a response to the government policy where, it paid our electricity bills for the past year. Well, I don't know if they're going to do that again. But those two factors, rather than higher interest rates, have clearly got us within the target range for the Reserve Bank. And they're continuing to push rates down. And even, it's not really matching particularly what the US is saying at the moment. And they're saying that there's no real outlook for interest rate changes for them, for their point of view. That's what the Fed has said. And that they've also said that they're now focusing more on the dynamics of the labour market rather than inflation in terms of their, decision making for interest rates. As I
Pretty
said,
much the same here too, I think, Andrew. The Reserve Bank said in their words they're cautious about their outlook. I guess they're more dovish, leaving the door open in their discussion to further interest rate drops. They're not as much worried about inflation as they are about our economic outlook.
I'm just wondering, other than the uncertainty over the international environment through,
Could be.
and that's been built up as the usual scare campaign because there's been actually nothing concrete come through. In fact, inflation was lower in the US over the first month of the so-called new tariff regime. So it certainly hasn't had any effect on prices. And the US economy is still surging ahead. Its job creation has been very strong. So there's been no material impact from tariffs. And yet we've seen with the stock market some hysterical reactions in terms of a collapse in share prices that has recovered to some degree. But this is all based on negative sentiment. And of course, that's fueled by the obsession with the media to promote bad news or the prospect of bad news because they know that's, the strongest form of clickbait there is out there. But as I said, at the end of the day, all our major measures of economic performance are positive. Our labour market's very strong at the moment. In fact, we could make an argument it's the strongest it's ever been in terms of the low unemployment rate and high participation rate. Retail sales are growing at their strongest rate in some time, so people are out there spending, which as usual is a conflict to some of those silly consumer sentiment surveys, which tend to be complete opposite to what's happening in reality. And of course, our housing market's chugging along quite nicely, Michael, looking to be the third year in a row with higher house prices, and that's going to be exacerbated by interest rate falls. So let's hope the economic outlook is benign because the more we cut rates, the less we have in our, less ammunition we have to stimulate the economy in case we do need it in relation to some sort of outside negative impact on our economy. And as I said, this is historically quite unusual to see interest rates being cut in an environment of a very strong economic performance. But, as I said, the Reserve Bank, as you mentioned, has said that they're uncertain. It's always the disclaimer in their commentary is that, they're uncertain, rates could go up, rates could go down. So I guess they're wary of perhaps having to change course, and they want to make sure that they can look back and say, we did say that we weren't 100% sure in what was happening and that things could change, which I guess is rational. But I think you've got to be very careful with movements, and just a personal opinion, of interest rates because it does create that margin for volatility and it can impact markets, as we know, particularly with housing markets going forward. As I said, we've got another month of data to absorb before we get the next decision from the Reserve Bank. But there's no sign of grey clouds or black clouds on the horizon in terms of Australia's economic performance. And I think we've had a hysterical reaction to, the change in US trade policy, which is up and down like a yo-yo. And I think now the commentary has largely become stale bad news, if there's such a thing. We're all sort of moving on from that. But as I said, I think the Reserve Bank's got to be a little careful about how much it cuts rates, particularly given that, we're now moving significantly away from the US rate, which will only put downward pressure on our dollar, which is good news for exporters, but not good news for inflation because it means we'll be paying more for our imports.
Well, last week, Andrew, we talked about jobs growth and how many new jobs are created in the current environment. And over the last week, there's also been indication of wages growth, again, a sign the economy's ticking over nicely.
Yeah, look, Michael, this is a very interesting data point. We get the wage index from the ABS released every quarter, and they have released the latest data, which is the March quarter data. But we've had some interesting results from the wage index over the past year, and quite counterintuitively, despite having a very strong economy, a low unemployment rate, high participation rate, still clearly a tough gig out there for employers looking for workers because there's strong competition amongst employers for workers. We did see a sharp fall in the wage index last year. The ABS put it down to the impact of the national wages case having the impact. I think there's some question marks here over the methodology of the ABS because we've gone from above 4% wages growth to near just 3% wages growth in the space of just a few months. I'm not sure that really reflects what's happening in the economy in regard to movements in wages. We'll shortly get the average weekly earnings data out. We can look at that to compare, but we're now starting to see, which I would have thought was almost a predictable rebound in wages, now up to 3.4% annually. But it's just really been a period where we scratched our heads a little bit in regard to why wages were falling so sharply, given how strong our labour market has continued to perform. But back up again, and what it means, of course, is with lower inflation that we've got real wages now rising, which is good news for wage earners out there, because inflation is now rising at a lower rate than wages are rising. So for the first time in a while, real wages are actually rising. But as I said, Michael, just a little bit of a query there over the data. I would expect to see, a continued rebound in wages going forward. But as you said, it's just another positive sign for the economy, how it's performing. But as I said, questionable data over the last year, given the other drivers of the economy and wages.
Well, it's not just a positive sign for the economy, but also for our housing markets. We know that when people feel wealthier, when they're more secure in their jobs, if they feel the rates are falling, they're more likely to buy. That's obviously going to stimulate the economy in all sorts of ways, in retail spending, but also they make big decisions such as moving house or buying investment properties, Andrew.
That's right, Michael. As I said, I'm trying to find the evidence that higher interest rates have contributed to lower inflation. I can't see it anywhere. And that's why the Reserve Bank continuing to tell us, that interest rate settings are restrictive. I think they're just looking at the historical evidence to say, well, this is what happened previously when rates were at this level. And I don't think we can do that. And it's grounds again for the Reserve Bank, having to backtrack in terms of its policy settings. And I think that's why there's a lot of disclaimers in what the Reserve Bank does say in its commentary, in terms of the outlook. And as I said, they can't keep relying on the doubts over US trade policy and its impact on the international policy, on the international economy, to justify dropping interest rates, because we will need to have some potential for accelerating the economy or pumping it up with lower interest rates, and we just don't want to be frittering that away, which I think, there's an argument for currently, and a number of other economists sort of feel the same way, Michael. But certainly it's a good news story for consumers, lower interest rates, and particularly a good news story for, the housing market, along with, as you said, higher wages now coming through.
I just wanted to remind you that this is not specific investment advice, because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of the opportunities the current property markets are offering. So why not have an obligation-free chat with one of the wealth strategists at Metropole to discuss your goals, your options, and what you could do. We're much more than just another buyer's agent. We help you safely create intergenerational wealth through strategic property and wealth advice. Remember, property investment's a process, not an event, so you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a home, go to metropole.com.au and organise a time for an obligation-free chat. You're going to find that at Metropole we're big enough to tip the scales in your favour, but still small enough to care. And since we don't have any properties to sell, our advice is independent and unbiased. Well, it showed on the weekend when again there were a lot more properties put to auction, but buyers were more confident, and clearly sellers are starting to become more confident. There's a lag, of course. Buyer confidence tends to come first, and then sellers eventually decide, I'm going to sell, and they put their house on the market, but there's a little lag. But auction numbers are picking up and auction clearance rates are holding well.
Yes, they are, Michael. We've certainly seen a lift, particularly in Melbourne and Sydney this year, and particularly in Melbourne, which has been the revival story of the year so far. Not that the other markets needed to revive, because they've been tracking quite positively over the last couple of years, but Melbourne's been an underperformer. But the results we had at the weekend, and look, it was also, as you mentioned, significantly higher listing numbers. Of course, we've moved past all those distractions through that holiday month of April and into early May. If we think about the Labor Day holiday up there in Queensland, in Brisbane. So now I guess we're into more normalised markets. We've got higher listing numbers, and we would expect to go through the next month with a with, as I said, a more of a normal market environment without distractions. And it's obviously also influenced by the interest rate cut, which would have, helped confidence from buyers out there. And as I said, or as you said, the results on the weekend were certainly positive again. 100 extra auctions in Sydney compared to the previous week. Clearance rates were higher in Sydney. Sydney's been tracking reasonably consistently in the low to mid 70% clearance rates, which is clearly a statistic in favour of sellers, and around about where it was a year ago, that Sydney market in terms of clearance rates and auction numbers. Melbourne, big lift in auctions. We're starting to see the numbers in Melbourne now, what we would expect, over 1,000 auctions in Melbourne, which is the leading auction centre, capital city, and another very solid clearance rate, not as high as the week before, but just slightly down, 72.1%. In fact, Michael, it's the first week in a month that Melbourne hasn't had the leading clearance rate.
Yes.
But wasn't far off. But certainly we've been saying we needed to see the next week and the next week to see if there was a consistency to Melbourne's revival. But we're certainly seeing that now with yet another 70% plus clearance rate. Brisbane, big rise in auctions, round about the same sort of numbers we expect in Brisbane in terms of a clearance rate. As we say every week, it has a different auction culture. So clearance rates tend to be lower there, notwithstanding the state of the market. Up a little bit from the weekend before. Adelaide's certainly been a market that's weakened from what it was a year ago, as when it was Australia's strongest capital city auction market, to now being still reasonably positive, but certainly not in those boom time results that we had a year ago. And Canberra, up a little bit. No clear breakout results from that Canberra market this year so far, or really over the last year or so. Higher auction numbers, 62.9%, which is quite a solid clearance rate going forward, but we're still waiting for that revival from the Canberra market. And when we look at the long-term trends, Sydney's been certainly improved significantly on where it finished last year and is tracking where it was a year ago. We would expect to see continued prices growth in the broader Sydney market, reflecting those clearance rates. And look at Melbourne, really significantly higher, not only from where it finished last year, but from where it was at the same period last year. So really positive signs there in the auction market. And we have seen that with prices growth in Melbourne. And the next week or so, Michael, will be releasing the May house price report, and that will give us, I think more confirmation of a revival in the Melbourne housing market. But certainly auction clearance rates have been significantly higher. And it was only really April, which was obviously impacted by those holiday results in Melbourne, which tend to be more noticeable in Melbourne than the other capitals. The auction market pauses due to holidays. But good news there for Melbourne continuing, for Melbourne sellers. And Brisbane just a little bit better than it's so far in May than its performance in most of the other months of the year, but still a little bit down from those very strong Brisbane results a year ago. Adelaide's been a weaker market from record levels a year ago. Some months we were seeing nearly 90% clearance rates, or some weeks we were starting to see, or we recorded 90% clearance rates in Adelaide a year ago, Michael, but now a little bit more subdued, that Adelaide market, and we've seen that with some weaker prices growth than those strong results last year. And Canberra, about the same, the Canberra market. Still probably in favour of buyers in Canberra, but and looking for a revival there. If you're looking for those weekly auction results, Saturday night we have the snapshot on the LinkedIn, my LinkedIn account, Doc Andrew Wilson at LinkedIn, and Michael publishes the full national report on Sundays through his channels, and that includes the regional breakdowns for Melbourne and Sydney and the top 10 sales over the past week in each of the capital cities. So another busy weekend, Michael. That's a busy week, really, with interest rate falls. Next week, we'll have a look at the latest inflation data, which will be interesting, of course, the monthly inflation data. And we'll also be able to have a look at the latest house price data for May.
Well, that's amazing. When you were saying that, I just realised at the end of this week, it's the end of May, 5 months of the year gone, almost halfway through the year. Look forward to catching up with you next week to see what's happening in our housing markets.
Thanks, Michael.